Hi, it's Dre Griggs with Obsidian Wisdom. Today we discuss what are the best ways to invest my retirement money. So when we retire, we normally have a certain amount of money that's set aside. When you look statistically, somewhere around $100,000 is what the average person will have for retirement. Then it becomes a question of what do I do with this money? I don't know if I have enough to be able to live off of 4% every year. I'm not sure if that's even the best choice for me. When I share with you guys the wealthy retirement system, I tell you that there's three things that we often need to invest our money in. And those three things are based off of the fact that the IRS tells us that 65% of self-made millionaires have at least three streams of income. And when you look at the seven streams of income that the IRS says that they recognize, we know one of them is not going to be retirement income, at least generally not, because that is earned income. You're actively working. When you look at the other six streams of income to decide which makes the most sense for you, they are normally broken into three types of investments. And they're normally going to be profits from a business. So you're going to have some sort of a business investment, or you're going to have some sort of real estate investments, which is going to be considered rental income. Now, technically, you could have equipment that you rent out. There are certain things that we could rent out, but for the most part, rental income is going to be for real estate. And then we're going to have income generated from the stock market. Now, this could be investment income, which could be your dividends. This could be interest income, which could be bonds that you invest in. Technically, you could look at investing in the stock market as investing in real estate. If you invest in REITs, you could also look at it as investing in businesses, because that's really what we're doing. We're buying stocks and businesses. Now, what we'll go over today is two specific examples where we'll just pull up some calculators that you could use online to be able to say, okay, this is how much I should expect to have. This is how much I'm going to need. And then this would be the best decision for me going forward. So first, what we're going to do is we're going to take a look at an asset allocation if I want to leave my money invested in the stock market. Now, I'll go over different portfolios for you guys, but today we're going to specifically look at what's considered the permanent portfolio. Now, I did take the extra step of not using my fancy software that I have as an RIA, but just being able to use Google and going to different websites that have free information. So you can see today I'm actually at portfoliocharts.com, which I do like this as far as a free one. And you can see that the permanent portfolio is 25% in the total stock market, 25% in long-term bonds, 25% in cash, and 25% in gold. Now, one of the cool things is they give you the information about who designed that portfolio, how long it's been around, and then they'll go over some of the reasons that they put it together. And you'll see, and we talk often about, there's normally going to be four types of economic environment that you want to make sure that you're protecting your money from. So you have stocks in times of economic growth or prosperity, you have cash in times of recession, you have gold for inflation, and then you have long-term treasuries for deflation. So you have a portfolio that's designed in a way that's going to do well in a certain environment. It's not going to do the best in other environments, but you're able to consistently get a return that helps you feel pretty comfortable. Now, one of the cool things is it gives you ETFs that you can use to build this type of an asset allocation, and they give you the lowest expense ratio possible. Next, if you want to be able to build this particular asset allocation, it gives you the types of ETFs that you would purchase. So you can see you have the ITOT, the VGLT, BIO, and the IAUM. And that's going to give you the 1/4 in the total stock market. It's going to give you a fourth of your portfolio in long-term bonds, a fourth of your portfolio in cash, and a fourth in gold. You can also see your overall expense ratio is going to be 0.08. Now, for someone who's already built the type of portfolio where you could just live off of 4% of the portfolio, where it's built at a certain size, or at least you got your expenses down to a certain amount, then this will be a good option for you. And the reason is you can see here, and one of the things I like is it gives you the annual returns of the perm portfolio, and it lets you know from 1970 to 2022 how it's performed. And you can see that it has lost money 23% of the time, and it has made money 77% of the time. And you can see that there is a small percentage of the time this portfolio will generate a 30% return, and you can see it's a small percent of the time that this portfolio could lose 20%. But that you can see the majority of the time this portfolio is going to get you a 4.5% return. And so you could decide to do that. You live off of 4%. And then you should be okay as far as maintaining this money throughout the rest of your retirement. And now for others of you, you may not have enough money to live off of 4%, or at least you don't have enough money that you could live off of this type of a portfolio where it's only generating 4.5%. Now, I could give you some other portfolios that could generate a higher return, but what I want to do is, in case you're in that percentage that doesn't have quite as much, I do talk to you guys about buying businesses, and I'm going to give you a quick example. So this is from Biz Buy Sell, and this particular one is a drop shipping jewelry business direct from manufacturers, which is a very fancy way of saying that they sell jewelry online. So they have some sort of a connection where they can get it for a lower price when they buy in bulk, and then they sell it at a retail price online through whatever their web store is. Now, if you had, and what we'll do is we'll go through this. So if you had, and they're only asking for $28,500, which obviously is a very low amount, And you would say, well, Dre, why are they asking for only 28,500? The truth is because this business is something that you could technically just kind of start out on your own. It's not like having a customer base inherently means that they're always going to buy from you. It does mean that they may buy from you, but if they just Googled and found the jewelry, then they don't have necessarily connection to your business. But normally service-based businesses, you're going to see them selling at a 2 times multiple. But this particular business, as you can see here, if you were spending 28,500 and you're interested in having some sort of a jewelry drop selling business, then you can see that you would actually be able to generate $64,000 in cash flow each year. Now, the reason that they probably have the lower amount is because it's not a consistent 64,000, even though that's probably a really good price. And they do go into some of the details. Now, I will tell you that when you just read through this, it does sound like they stuck it in ChatGPT and said, make it sound as markety as possible, which is fine. They just have a bunch of those words that would draw someone's attention, but we'll go through and look at the numbers. And so you can see in the most recent fiscal year, April of 2022 to April of 2023, they had sales of $231,000, resulting in a net profit of $71,000, right? Which is pretty good. And so you can see here that you spend $28,500, and then you were able to start generating $71,000 in retirement income each year. Now, of course, it does fluctuate, and they give you those numbers. So in April of 21, April of 22, it says that their sales were $191,000 with a net profit of $52,000. Again, I still spent $28,500, and now I'm able to generate $1,000 every single week in retirement income. Again, that's still pretty good. And then you can see from 2020 to 2021 and 2019 to 2020, they had revenues of $153,000 and $143,000 with about $29,500 and $27,000 respectively in income that they were able to net. So again, that is a pretty good opportunity for someone. I do like the idea of buying businesses because if you're able to buy a business that already exists, it's already generating a certain cash flow, you're going to get a much higher return than if you had your money invested in the stock market. Now, again, a business is still considered a risky investment. And what I mean by a risky investment is I could technically lose all of my money. When you invest in the stock market, you could technically lose all of your money. When you're investing in businesses, you could technically lose all of your money. But as far as managing the risk, these are really good opportunities to be able to do that. And so the third option would be rental income. Now I went to calculator.net. Again, I wanted to find options that were free and easy for you guys to be able to access. And what you can see here in the rental income is this particular option has an internal rate of return of 20%, which is pretty good. I got a 20% return. And then the net profits will be $429,000. And then your cash on cash return is 932%. And your capitalization rate is about 8.5%, which is all really good. Now your capitalization rate is, if it's just your net income divided by whatever the market value is, and then it tells you on average how many years it's going to take for you to get your money back. So if you had a 10-year capitalization rate, it's going to take you about 10 years to get whatever that money you invested back. So you can see your total rental income is about $612,000. Your mortgage payment is about $230,000. And then your expected expenses is about $153,000 with a net operating income of $459,000. They would say, okay, Dre, what did you put into that calculator? And I'm glad you asked. So let me go through this. What I did is I said, okay, let's find a $200,000 home and then we'll put 20% down. That's about what it would cost to have an investment property. You're not going to be able to get the lower rates that you normally get if you're going to live on the property. So what that then gave us is about a $46,000 expense that we had to pay at the beginning. And then what we said is what would be the expected income that that type of a property would generate. And what the 1% rule says is that whatever the market value of that property is, 1% of that should be what my monthly rent is. So if the property is worth $200,000, then I should expect a monthly income of about $2,000. So that's what we did. And then per year, that would give you $24,000. And then we calculated the mortgage payments just based on the averages, my vacancy rate, which just means no one's living there. You said a 5% vacancy rate. So that's how much money that would ultimately cost you. And then we did the property taxes, which is about 1% of what my market value is. And then we did the maintenance costs, which is about 1 to 3%. So we did 1% of what the total market value of the property is. And then just any other costs that we would end up having, that would give us about a $465 a month net positive. So that would be our cash flow. And so one property would give us about $6,000 a year. What I did is I only had to spend, as you saw, $46,000. And then I was able to generate about $6,000 a year. Now, what that ultimately means is that's probably not enough for most of you, even with Social Security, So if you had $100,000, then you may need to buy two properties. And then what you would do is you would double all of these numbers. And so what you do is you spent $46,000, and then you can see that your annual income is going to be based off of this 22,800, and then it's going to go up by about 3% each year. Your mortgage payment does not. And then your expenses go up by about that same 3% each year. And then you have what your cash flow will be, and then your cash on cash rate of return. Again, I'm just at calculator.net where it gives you this information, and then you can feel pretty confident in your numbers. And then you would just decide when you want to sell the property. I know some people that will keep the property for 10 years and then they'll sell one of them, and then they'll have that cash flow that they can then spend in retirement. Others will just keep adding properties where you're saying, okay, well, if I have some other money set aside and then I bought one property, maybe I can live off the other investment income that I have. And if that's something that you can do, then you could just continue to allow this to compound on itself, where every single year you get another $6,000. And then in 5 years, every 5 years, you buy another property. Now, because we're already retired, that may have been a strategy that you wanted to start a little bit earlier, but it does show that it is something that you could do. And so most of the time when I talk to people about their investment, they're normally saying, okay, I'm going to put my money in my 401k. But the reason I normally caution you guys about the 401k is twofold. One is you're putting your money in something that you're not even allowed to touch till you're at least 59 and a half. There's not many investments that you would say, if I told you, hey, look, I'm not going to guarantee any rate of return. And if you put this money in your 20s, you're not allowed to touch it for 40 years. And if for some reason you do touch it, I'm allowed to charge you this huge penalty, and then you'll pay some taxes on it. And you'll probably say, I don't know if that sounds like a good investment. And I would say normally the same thing. If I'm going to give someone my money for 40 years and it's tied up, I would normally expect a guarantee of some significant amount, because there's so much I could have done with my money over that 40 years, which often I do think a lot of us overlook when we're just saying, I'm going to put all my money in my 401k. When it comes to making better investment choices, you can see that following the path that self-made millionaires have used, and that the IRS says that they recognize as the 7 streams of income, that it makes most sense to invest your money in real estate, the stock market, or in other businesses. And when you do this, you're able to have your money set aside in a way where you can maximize your returns. Now, for some of us, we could just invest in the stock market and get a nice return. But for others of us, we have to be a little more creative.